Thank you all for joining me today. My name is Bill Sablan, and I'm a partner with Now CFO. This is the fourth part in a series on financial visibility. Today we'll be going over the month close process and how it contributes to having accurate, timely, relevant, and insightful financial data. In previous sessions, we talked about management accounting, budgeting, and today we'll be talking about the monthly close process. One common theme in all of these is your mindset. In some cases, depending on where your business is in its life cycle, these processes may not seem like a big deal, but a shaky accounting foundation can lead to major headaches down the road. Establishing good habits now will force you to look at your business in a specific way and to start getting familiar with what drives income, expenses, and see where you're getting value. So in part 2, we talked about management accounting versus financial accounting. Financial accounting looks backwards, but management accounting is forward-looking. In part 3, we talked about budgeting, which is also looking ahead. Now, in part 4, the process of closing the books is specifically geared toward what happened in the month past, so it's a bit of a change of pace. However, although the task itself is backwards looking, the importance of it is how you use it to look forward and run your business. First, let's talk about what it means to close the month or close your books. There are 4 basic parts in a typical month close process: journal entries and adjustments, reconciliations, variance analysis, and financial statement preparation. The most common type of journal entries are expense accruals and prepaid amortization. What these adjustments are doing is making sure the expense is being recorded in the period that it is incurred. For example, let's say your attorney does some work for you on October 31st. Then, he goes home that evening and has some fun with his kids on Halloween and forgets to send you his bill. You don't want to put your business on hold waiting for all of your bills to come in, so in order to get the most accurate and complete picture of your month financially, you need to accrue an estimate of what the expense is. Your business can have a lot or a few adjustments, but the idea is still the same. You want a complete financial picture and not have it be subject to the timing of an invoice or cash receipt. Another part of the month close is doing the reconciliations. The most common type is a bank reconciliation, but there can also be other accounts as well. For example, reconciling the accounts payable amount on your trial balance to your AP aging report. Doing these reconciliations can ensure that all transactions have been entered and that you have a complete picture of your financial situation. For example, you might look at the balance in your bank account and think you have enough money for the week, but maybe you forgot about some checks you wrote that hadn't cleared the bank yet. Those outstanding checks will be captured in the bank reconciliation and give you a true look at your cash balance. If you've done all your reconciliations and made all your adjustments, you're now ready to do your variance analysis. This is where it's important that you've been doing consistent monthly closes. Variance analysis is about looking at accounts over time and seeing if there's an amount that stands out. This is usually a good indicator that something was missed or entered incorrectly. For example, if you see that every month you spend about $200 on your cell phone, and then one month it says $400, you would know to look into that. Maybe the bill got entered twice on accident. Also, just because an amount isn't similar to prior months isn't necessarily cause for alarm. There could be a valid reason spending was up, but understanding that is important to understanding your business. The other type of variance analysis was discussed in the previous session, which is comparing actual results to the budget. Were your results off the mark? Or are you operating as expected and hitting your targets? Now that you've made all your adjustments, done the reconciliations, and completed your variance analysis, you should feel confident that your numbers are accurate. Now you can prepare your financial statements. For internal purposes, this can usually be as simple as pushing a button in your accounting software, but you want to keep a record of your monthly financial statements. Once all of this is done, your books are now closed. What that means is you shouldn't be making any more changes to the month. If you discover something later, make the adjustment in the current open month. I mentioned at the beginning that doing these things is a mindset. What that means is you are constantly evaluating and learning about your business. but you have to be learning in a timely manner. A good month close should be no more than 7 days and can be done in as little time as 1 day. Dealing with red flags or emphasizing positives sooner rather than later will be that much better for your business. Thank you for joining me today. I look forward to answering any questions you have in the chat, or you can email me anytime at this address.